Hello everybody, it's Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. And I'm experimenting with doing a series of videos on different types of investing, our common stock investments. I'm going to be focusing on dividend growth stocks in this particular video, but I'll also plan on showing some videos on some real pure growth stocks and other investment classes as well. But I'm really excited about featuring Cisco here for a couple of reasons. Number one is it is a very high quality dividend growth stock. As you can see, it's AA rated, has only about 27% debt. It currently is trading at a PE ratio under 15, which is something I always consider attractive from a valuation perspective. That means the earnings yield is above 6.5%. The dividend yield is 3.1%. And I do want to focus on the company's growth rate. Historically, it's grown at double-digit rates going back to 2000. But I'm going to talk more about that here in a moment. So what I want you to see is that this is a quintessential of an extremely high-quality technology growth stock that is actually morphing into a dividend growth stock. And so if you look at this company, I want you to notice a couple of things. If I take my scroll bar and go back to just coming into the Great Recession towards the middle of 2008, this company was actually growing at 17% a year during that time frame. Now that included a couple of down years during the recession of 2001. But I want you to just look at these year-to-year growth rates here. In 03 it grew at 51%, 29, 21, 20, 22, 16. So this was purely a growth stock and was growing at very, very high rates. But now what's happened is over time, this company has morphed into now a dividend growth stock. I want you to notice they instituted their first dividend in 2011. They paid 12 cents a share. They more than doubled it the next year and virtually doubled it again the following year before they kind of settled down into more of a pattern. And I'll be showing you a little bit more on that. So the company is now a dividend growth stock with a 3.1% dividend yield. The dividends stacked on top of earnings illustrate how these dividends are being paid out to the shareholders. Under here, these are when the dividends belong to the corporation. But here's what I want to get across. This company over this time frame had an average growth rate of 10.1%. But if I shorten this time frame to just roughly the last decade or so, I want you to notice that that earnings growth has fallen to about 6.75%. And this is during the time, about the time they start instituting a dividend. I cut a couple of more years off and we're averaging this 6.7, we'll call it 6 to 7% earnings growth. And the key issue here is this is very, very common to see once, high profile, high and very powerful growth stocks, pure growth stocks, eventually morph into dividend growth stocks. We've seen that with Microsoft and we've seen that frankly with a lot of other companies as well. So now we've got a dividend growth stock rather than just a pure growth stock. So the lessons that this company teaches in valuation, though, are unbelievably extraordinary. And so I'm going to interject or include monthly closing stock prices here. And I'm going to talk a little bit about some historical valuations first before I focus too much on current valuation. If you look back at Cisco during the 1999-2000 era, you see this complete disconnect from earnings. This is the classic picture of the tech bubble. Cisco's PE ratio got up to 161, and there was absolutely no rational business or profit incentive that could have indicated that this stock was worth 160 times earnings. It was growing very fast at that time. Technology was coming into its own, but this was clearly a quintessential example of what they call a greater fool stock. You were foolishly buying it at these high levels only on the basis that a fool greater than you might come along and pay you more, and that doesn't happen very often. Now that culminated in a total collapse. If you go from peak to trough here, where the stock was trading at $77 a share back in March of 2000, and take it down to its trough valuation by September of 2002, so this, roughly, we'll call it just a little bit over 2-year time frame, you would have lost 86% of your money in Cisco had you bought it at this peak and watched it fall this much. So that's a significant adjustment, if you will. But what's even more interesting about this is that the company during this time frame, they did have a couple of down years during the recession, but the crack in the armor started to happen before the recession actually hit. But once the recession hit, of course, it settled down even more. But even then, I want you to notice the company was still trading at very high valuations. Now, this growth during this period right here was very strong, but notwithstanding that, the stock was still overvalued. So even after this massive massive correction. Had you bought this coming out of the recession of 2001 and held it into the throes of the recession in 2002, you'd have continued to lose money. And this is a time when the company was doing great as a business prior to them paying a dividend. My point being is valuation is so critically important, and the reality is the market had totally disconnected the market value of Cisco from the intrinsic value of the business itself. Finally, the Great Recession brought us a reversion to the mean, a cleansing, if you will. We did have a down year, but it wasn't a catastrophic down year. Earnings fell 13%. By the way, Cisco has a July fiscal year through July 2009, but then they recovered pretty quickly here in fiscal year 2010, and they've kind of stayed that way ever since. But in the process of this is now a $191 billion market cap company. So that's obviously a behemoth at this point. So as we start looking at these newer time frames or more recent time frames like I showed you a minute ago, the company has been attractively valued probably since 2009, 2010, but I'll talk more about that later. But here's why valuation is so insidious. If Cisco still, after 20 years, has not gotten anywhere near, back to the price that it once traded at when we were in the middle of the tech bubble. Now, this is an extreme example. I grant you that, perhaps one of the most extreme examples I could even possibly show you, but sometimes the real knowledge, the real insights are given at the extreme. Overvaluation can destroy even a great company like this because throughout all of this, the business actually did well. But now let's talk about why I'm writing about Cisco today and why I think it's an attractive investment. So I'll shorten the time frame again, and we're going to look at it from just about the time they started paying a dividend. We've got this lower growth rate of 6.97%, but the stock was clearly attractive coming back in the beginning of 2010 here. It was overvalued for most of 2019, and so therefore I wouldn't have been recommending that anyone research it or consider it for investment. But now we've had this nice correction, and the stock is now under the orange line, trading at a PE of 14 with this 3% dividend yield. And for the time that it's paid dividends, it's grown them at an extraordinary rate. But I want to emphasize, I remember I mentioned in the beginning that they, more than doubled their dividend for the first couple years that they paid one. So if I kind of shorten this time frame to a little more I'll call it normal time frame, we still get a company that's growing their dividend by 14% on average over this time frame. However, it only grew it by 13% in 2018 and only by just under 10% in 2019, which again, fiscal year ended in July. Nevertheless, this has got a great track record. If you look at total performance here, you can see that it's just about mirrored the market during this time frame. Remember, we've been in one of the most extraordinary bull markets in history. The dividend income, though, has been significantly better than the S&P 500. And I also want to point out, as I mentioned in my last video, that the market is fully valued to now to moderately overvalued, and Cisco is undervalued. So we're comparing an undervalued stock to an overvalued market during this time frame. And nevertheless, we now have an opportunity, I think, to start considering Cisco. Now, during this last, period of time since 2013, fiscal year 13 and 14, this stock has traded at about a 13.5 we'll call it a 14 PE, which is more or less where it's at now. It's a little above that here. So, I'm not saying this has become a bargain, but what I'm saying is it has now become an opportunity to invest in an extremely high quality dividend growth stock, which it has now become, as I illustrated, with the fact since they started paying a dividend as their growth rate slowed down, and they have a great record of growing their dividend. But now let's look at the safety of that dividend real quick. If I go to operating cash flow, you'll see that the correlation between operating cash flow and the stock price is also very high. The normal priced operating cash is about 11.5. It currently trades at around 13. It is below the orange line, but perhaps slightly above the blue line. So this valuation reference would tell us it's fully valued, not overvalued by any stretch of the imagination, but fully valued. But the more important aspect here is that operating cash flows are significantly covering the dividends. And if I expand this graph out to the whole length that I originally was talking about, I do want you to see that this company has been a very prodigious cash flow generator. The company has historically always generated really strong cash flows. And then if I go into free cash flows, that's also extremely important. They've also generated a lot of free cash flow. And then, of course, since the company's been paying a dividend, if I go back to this shorter time frame, I want you to see that their dividend is more than amply covered by free cash flow. You know, they're generating $3.35 of free cash flow this year, covering a $1.36 dividend. That's for fiscal 2019 that ended in July. Now, if I measure this stock on any of the other typical valuation metrics that I like to utilize to value a stock, you know, it might be a little pricey relative to its normal price to EBITDA. But again, it's now coming into a point where the stock can be considered for those who are looking for a high quality company that has a above average market yield with good dividend growth and very low debt relative to many companies in the industry now. I want to turn to fund graphs a little bit and talk about a couple of things that I want you to be aware of from a standpoint. I'm going to go right into the percentage graph, and I want to look at gross and net profit margins because I want to talk about this a little bit. If you look more recently, in 2018, their net margin virtually disappeared. And the reason for that was the institution of the Tax Act, where, you know, the transition tax on accumulated earnings of foreign subsidies was made. And so they ended up with a very large tax hit. So it was a non-recurring event. Otherwise, I want you to notice that their gross and net margins have actually been very stable as an operating business, dropping slightly quarter to quarter here for the last couple of quarters. But this company is currently in transition, and that's something I would expect you, or I would hope you would dig a little deeper in and learn more about the company. They're really beginning to, their goal is to have 50% of their gross revenues on the subscription business, and they're rapidly approaching that, and they're being very successful in that regard. Hardware's been somewhat of a problem, which they're known for with their routers and other hardware, but they're now moving more into a subscription service business, and that's helpful. The company has been reducing share count a little bit in recent years. Their share count since 2011 has gone from 5.56 billion to 4.58. I consider that a moderate negative, and let me explain why. I think, you know, they were buying back stock in 2017 and 2018. Now, my theory of that is if I see a company buying back their stock, I want them to be buying it back when I personally would be investing in the stock. So 2017 was okay. The stock was reasonably priced, so I have no problem. 2018, I might have, you know, wish that the company wasn't buying stock back then, but it was, but they weren't massively overpaying for it. I think this year, their average price per share buybacks around $48 a share, in the stock, you know, after yesterday's close is trading at 45. I think it's down a little bit today. But the whole point is, if I look at the future for this company and look at it from a standpoint of analyst estimates, it's widely followed. We're forecasting about 4.5% growth. As I always like to say, I never buy a stock without having a specific idea of what kind of return I might be able to earn. In the case of Cisco, I'm looking at it for its generous dividend yield of 3% that has a history of growing. So by fiscal year 2020 ending in July, I could expect to make about 14, almost 15% a year. Drops down to about 10.5% in 2011. Usually I don't like to go out too much further. If I look at long-term growth, the growth expectations for the analysts reporting to FactSet are for 5% growth. If I check other sources, like if I go into Yahoo Finance here and look at the 3 to 5 year growth under Yahoo Finance, it's 6.99, or we'll call it 7%. So if I go into my custom calculator here and I draw this as a 7% grower rather than a 5% grower, well, before I do that, let me run the calculations. When I'm looking long-term like this, I like to run out to the end here. So it could be an 8 or 9% average annualized total rate of return investment at normal valuations, etc. If I draw this as a 7% growth rate, like the analyst from Reuters thing, again, it could be a double-digit annualized rate of return. So considering the quality of this company, I believe believe this is really an excellent time to start doing some work on Cisco. And of course, I definitely recommend buying it on weakness, but I like this company very much. I think it's an extremely high quality company. There's a lot going on in technology, which is always a little bit risky, but you got 5G coming up, and I think this company is very well positioned, that there's a high probability or even possibility that all of these forecasts for earnings growth and everything could end up being understated. In other words, the company at some point in time in the next year or two could actually accelerate their growth rate, and that's certainly a possibility. But even if that doesn't happen, I would consider this company an excellent opportunity for those investors who are looking for dividend income and dividend growth at a very, very high quality company at an attractive valuation. Cisco might be one you want to spend a little time researching. Anyway, this has been Chuck Carnevale saying thanks for watching. If you like what you saw here, don't forget to give me a like, and also subscribe to our YouTube channel so you can get more videos like this coming up. As I mentioned, I'm going to be covering not just dividend growth stocks, but also some growth stocks here in future installments. Thanks for watching.